You were probably told this was a crisis, that Venezuela was about to break markets, send oil prices flying, and somehow sneak into your gas bill. Headlines were loud, dramatic, and confident, which is usually your first clue to be suspicious. Because when this news actually hit the market, almost nothing happened. No panic, no sell-off, no sudden rush to cash. And that silence tells us more than the noise ever could. Markets don't react to emotions. They react to incentives. And what we saw wasn't chaos, it was precision. Energy stocks moved higher, sharply and specifically, while everything else stayed calm. Not because the world was ending, but because Wall Street saw contracts, access, opportunity. The kind of stuff markets actually care about. The reason energy stocks reacted is simple. If Venezuela opens back up, they're the ones getting invited to the table. The US government is already talking with major oil companies, and there's a very practical reason for that. American refineries are built to process Venezuela's oil-thick, heavy crudes that's ideal for producing diesel. And diesel matters. It runs trucks, construction equipment, military vehicles, agriculture, the boring, unsexy things that keep the economy from face-planting. On paper, this all sounds huge. Until you zoom out. Globally, the world produces about 100 million barrels of oil per day. Venezuela currently produces less than 1 million. Back in the day, when Venezuela pumped 2 or 3 million barrels daily, it mattered. It could move prices. Today, it's less than 1% of global supply. Massive reserves, yes. Meaningful production. Not anymore. Years of mismanagement, underinvestment, and talent leaving the country turned an oil superpower into a footnote. That's why oil prices barely reacted, not because the news didn't matter, but because fundamentals still rule. Venezuela simply isn't a big enough producer right now to shock the market. So no, gas prices aren't about to skyrocket or collapse because of this. At least not in the short term. Reviving Venezuela's oil industry isn't flipping a switch. It's rebuilding infrastructure, restoring stability, bringing back talent, and fixing systems that have been decaying for decades. Even the optimistic timelines being floated like 18 months assume that nothing goes wrong. And historically, when geopolitics is involved, things usually get worse before they get better. In theory, the plan looks clean. Political change, new government. The US gains access to cheap oil, gold, and rare earths. Inflation stays lower, growth improves, and everyone claims victory. Venezuela gets royalties, and a path forward, though probably not a fair one. That's the brochure version. Reality is slower, messier, and far less predictable. And that uncertainty is exactly where markets told the real story, not through oil, but through gold. Gold moved higher after the news. Not violently, not in panic, just steadily. And that's important, because gold doesn't only move when markets crash. Gold moves when confidence starts to soften. When things aren't breaking, but they're no longer unquestioned. A lot of people think gold and stocks have to move in opposite directions. That's wrong. Stocks respond to liquidity, earnings expectations, and growth narratives. Gold responds to uncertainty, geopolitical risk, and trust in the system. Right now, we have rising liquidity. The Federal Reserve is still injecting tens of billions a month, and rising geopolitical tension at the same time. That combination is basically gold's ideal environment. This isn't a fear trade. It's a trust trade. When governments, institutions, and central banks start questioning long-term predictability, hey, don't abandon the system overnight. They hedge it, quietly. That's why central banks keep buying gold. That's why gold reacts to geopolitical news, even when stock markets are calm. And Venezuela isn't an isolated story. It's part of a much bigger pattern. China, Russia, and the broader BRICS bloc are slowly destabilizing. Not because the dollar is collapsing tomorrow, but because the dollar comes with conditions and enforcement. When Russia invaded Ukraine, the West froze roughly $300 billion of Russian assets. Whether you agree with that or not isn't the point. The point is that every country watching learned a lesson. If your assets are digital and held within the dollar system, access is conditional. China noticed. They've slowed treasury purchases, let existing holdings roll off, and redirected surplus capital into gold. Venezuela noticed too. Selling oil outside the dollar system crossed a red line. What followed wasn't subtle. Other countries see patterns, and patterns change behavior. This doesn't end dollar dominance, but it absolutely encourages hedging around it. So when you zoom all the way out, here's what actually matters. Markets are calm. Oil is pricing fundamentals, not emotion. The US economy isn't facing a shock, but beneath the surface, capital is adjusting. Gold is pricing uncertainty. The dollar remains dominant, but it's no longer unquestioned. The system didn't break. It did exactly what it was designed to do, adapt quietly before the crowd notices. And if history is any guide, by the time this story feels obvious, the market will already be focused on the next one.